This is the channel where I went to business school so you didn't need to, and today we are talking about a strategy that I have learned which outpaces the returns of the S&P 500 index without taking on any unnecessary risks. I will also briefly talk about at the end of the video another investment strategy where you can set it and forget it so you can beat the S&P 500 without doing anything. This video has 4 main parts. The first part tells us the key points and what our goal is for this portfolio that we will make in this video. The second part tells us which stock investment types should be in our portfolio to reach our goal. Then in the third part, we will go over the risks of this particular strategy. And finally, I will show you a specific investment and various investments that I have personally bought to implement these 2 investing strategies. So let us start with part 1. This strategy is one of the best ways for most investors to achieve long-term growth in the stock market that beats the S&P 500 stock market benchmark. I want to make it clear that I did not personally create this strategy. This investing strategy is based on the best academic research that I could find at my business school, and this research is also supported by many articles such as the one on screen. I am convinced that investors who invest beyond the S&P 500 index will achieve more long-term success if they pick and manage their risk tolerance and investments wisely. Over 90% of retail and professional investors do not outperform the overall stock market in the long run, which means your chances of beating the S&P 500 stock market benchmark without these 2 strategies is very unlikely. Over the course of more than 50 years, investors who have held the S&P 500 and 9 other stock investments could have more than doubled their money as opposed to just investing into the S&P 500, which already beats 90% of investors. This all-equity portfolio automatically takes advantage of stock market opportunities whenever and wherever they arrive in the various sectors of the stock market. Over the past 52 calendar years, from 1970 to 2021, the S&P 500 has grown by around an 11% CAGR, which is their compounding annual growth rate. That would mean an initial investment of $100,000 in 1970 would be worth $23.1 million by the end of 2021. Part 2. For the purposes of our discussion, consider the S&P 500 index as our first and largest position in our portfolio. However, as the video progresses, we will have a total of 10 investments in the portfolio, each with a 10% portfolio weight and allocation. This would mean the S&P 500 currently makes up 100% of our portfolio because it is our only investment in the portfolio at this time. The next step that we should do is to move a 10% allocation of our portfolio from the S&P 500 and invest it into a large value stock or ETF like RPV. This translates to our second position, which means we still have a 90% allocation to the S&P 500 and a 10% allocation to RPV. On an annualized basis, this one change would change our 52-year return from 11% to 11.2%. It may not seem like much, but this small step would have turned that $100,000 investment in 1970 into $25 million instead of just $23.1 million. So we literally gained an extra $1.9 million just by adding this other ETF. Our third position would be another 10% allocation by investing into a mix of US small cap stocks, thus reducing the weighting of the S&P 500 in our portfolio down to 80%. This can be achieved by investing into an ETF like ticker symbol IJR. This pushes the 52-year return up to 11.3% now, to where now our original $100,000 would have grown to $26.7 million. For our fourth position, we will shift another 10% of our portfolio to the United States small cap value stocks. which have been the top performers of all US asset classes as of late. This can be achieved by investing into ticker symbol AVUV. That would pump our total returns up to 11.7%, which makes our initial and original $100,000 investment to now be worth $31.7 million. Honestly, you could stop after each of these steps depending on your own strategy's investment style and risk tolerance, but this strategy gets even better. To remain consistent, we will now add a fifth position by adding an additional 10% allocation to a United States REIT fund by investing into ticker symbol VNQ. This will give us passive income in the form of strong dividends and cash flows in times of economic uncertainty, but make sure you have drip investing enabled in your brokerage account, IRA, or 401k so your dividends get reinvested back into the assets which produce them to enhance the compounding effect so our money is literally making money while the portfolio is making money. Let us check back on our current results. We will now have a return of 11.8%, adding another $1 million to our total just by simply adding REITs and the dividends that they would give us in times when the stock market would be downtrending. Now, from this part on, this is where it really gets into investors' preference. So I myself am still weighing the risk to reward of this particular part because I like to localize my investments mainly in the United States of America, but I do own some foreign stocks. To add context to this, the next step would be to use international diversification in company and stocks to our advantage. If you do not want to add foreign stocks, then just wait until we go over the specific investments at the end of the video. However, if you all want to copy this exact portfolio, I'm going to go over 4 positions, which means we are going to have a 40% portfolio weight outside of the United States in this particular regard. This would also mean that we are giving each of these investments a 10% allocation and portfolio weight. We're going to start with international large cap stocks and ETFs such as AVDE. Next, we're going to move on and add international large cap value stocks by investing into ETF ticker symbol EFV. Then we're going to add international small cap blend stocks such as FNDC. And lastly, we will add international small cap value stocks such as an ETF like AVDV. This reduces the portfolio weight of the S&P 500 in our portfolio down to just 20%. But let's check back on our returns. We would now have a total of an annual compounding 12.3% growth rate over the last 52 years, and a total portfolio value of $40.8 million just from our original $100,000 investment. And the final position that we will add is going to be another 10% portfolio allocation to an emerging markets investment that represents countries with expanding economies and prospects for rapid growth. An investment that would match this position would be an ETF such as ticker symbol AVEM. That investment would boost our total returns to 12.6% annually over 52 years, which would give us a total value of $47.7 million. That is more than double what just the S&P 500 would give us alone. And remember, the S&P 500 already beats out 90% of retail investors and professionals. So if we could even double that over the long term, this is a phenomenal investment. Over the past 52 calendar years, this 10-part portfolio has met every asset class forecast of academic analysis, and it has more than doubled the dollar return of the S&P 500. So now how do we build this portfolio? You can build this portfolio by using exchange-traded funds, also known as ETFs, or mutual funds, or even by buying single stocks. But remember, depending on how you build your 10-fund portfolio, it will impact your end results. Here is a tip. When looking for good ETFs or mutual funds, make sure that they are passively managed and that they have low expense ratios. The ETFs that I mentioned are definitely not my top picks, but the articles and the research seems to really like the ones that I mentioned. However, they would not be my favorites. On screen, I will actually show you a list of all of the various ETFs that would fall under these particular asset and investment stock types, particularly in the form of an ETF. Now let's move on to part 3 of the video. Best of all, this strategy works without you having to go out and find individual stocks. You don't have to research these ETFs. They are very broad and they're already diversified, and they give investors fantastic returns over the long term. This means you're not going to have to go out, research, and buy and sell individual stocks by trying to predict the future of the market in the short term, because the market will inevitably have its ups and downs. But this portfolio will protect you against the volatility and the downside due to its diversification. Now, there are drawbacks to this particular strategy. This requires you to periodically adjust all 10 of your positions depending on the current stock market environment, but few investors have time or the inclination to do so. One of the first things many investors ask me is how they can keep up with changing these stocks based on the environment, and how much additional risk are they adding by actively managing their own portfolio. I do agree with them that yes, this portfolio does have a higher beta ratio than the S&P 500, which means it's more volatile, but through its diversification, it only tracks with the S&P 500 by only a few percentage points. What do I mean by that? It means when the stocks drop and the stock market pulls back, either in a economic downturn, recession, or a stock market crash, it's only going to have a couple more percentage point loss than the S&P 500 itself. But through its diversification, it's going to be way better off than a plethora of just individual stocks, or stocks that you are betting very heavily on that are extremely volatile. But when the market rebounds, this strategy outpaces the S&P 500 and other indexes in the form of millions of dollars worth of value, which are going to be on the line. Lastly, I want to say that the past does not predict the future. So even though this portfolio and this strategy has performed extremely well over the last 52 years, we don't know what it's going to be like in the future. However, I anticipate that the long-term returns of this ultimate buy and hold strategy will return greater gains than the indexes over the long term. But there is no way to know this for sure. If this strategy seems too complex and you don't want to actively manage your own portfolio, you don't technically have to. You could just invest into these ETFs and just consistently invest into them over time, or you could do our second strategy, and that would be to simply invest into ETFs like ticker symbol MTUM, VTI, QQQ, and SPWD. These 4 ETFs should be equally weighted in your portfolio. 25% allocated to MTUM, VTI should have a 25% portfolio weight, QQQ should also have a 25% weighting to it, and SPDW should make up the rest of it, which would be a 25% position. This will prevent you from having to actively manage your portfolio and rebalance it according to the current stock market. So you could literally just invest into those 4 ETFs on a cyclical basis through dollar cost averaging and just forget about it. They don't need to be managed. Literally simply dollar cost average into them by investing into them as much as possible, as consistently as possible, every paycheck for the rest of your life, and those 4 ETFs will build you wealth over the long term. I would really appreciate it if you shared this video with your friends, especially if you enjoyed it. Smash that like button for more videos just like this one. Comment your questions and thoughts down below, and I will see you in the next YT video.